I need a haircut again. Woden's Day, yes. Exhibit 6, US long-term real interest rates. Inflation taken into account and whatever. And you can see it goes back to 1919. Now, I don't know what to make of much of the first lots of charts I'm going to put up to you. I'm going to leave them up to you. I'm just going to present them as they are. So long-term nominal treasury yield minus estimation for inflation expectations, real interest rates. 1980, they were high, about 10%, and have just come down, top left, bottom right, ever since then. 30 years, haven't they? You can see the trend from up there at 10 down to now at, well, it's actually, if that's updated, minus. So it's gone from 10% down to minus 1 or 2%. Right, moving on. These are interesting for the sake of interest, and I'm going to leave you to make something of them. 1974, over on the left there, that grey bar, is when you needed nearly 1 hour of work to buy a bushel of corn. Yes, this is a bit odd, but you can just see the shape of this. Up at 1974, it was at its highest, and it came down to this particular one, I'm going to say to 2002, because that's what the others are going to be. But you can see it comes from a very high down to a low, and then starts taking off again from the start of this millennium, and is going up again. Right, this is hours of work needed to buy 100 pounds of cotton. These are just things that are used on the commodities markets in these amounts. This is why they're being used by the chart store. And you can see 1974 was the high thing again, and it comes down to, this is even clearer, 2002, where you could say it goes along a bit and then goes up. But basically from 2002 the trend has been going up again. This is hours of work needed to buy the S&P, the stock market, the S&P 500. Now, this is different, and I should have put it in another way round, but we'll just have to keep our minds alive here. 1974, it started to try and get up, but never really got going until the 1981. And then it took off all the way up to, let's say, 2002, and then for 2002 the trend has been down. But this is the stock market. This is not real commodities. This is the stock market. Okay, going on, the hours work needed to buy an ounce of gold. 1980 again, we've got this, the two numbers at the start, 1974 or 1980, and this is a 1981, and then that comes all the way down to 2002, and then really rises up an awful lot, and you now need 90 hours of work, standard measuring, Bureau of Labour Statistics, whatever, 90 hours work to buy an ounce of gold. But the shape is clear. It's either from a 74 and an 80 down to a 2002 and up again, or it was the other way around for the stock market. Here's another one just for fun. This is the hours of work needed to buy a metric ton of copper, if you wanted a metric ton of copper. And as you can see, the highest spike is that 74 one again, but the whole trend is really coming down from 1966 all the way down to 2002, and then it goes off up again, and you have to now work nearly 500 hours to get your metric ton of copper that you so much need, when you only needed 100 hours of work to get your metric ton of copper in 2002. Right. The whole CRB index is all of these commodities all lumped together in one index, so you can follow how things are doing as a great big lumped together thing. And we can see our famous shape. 1974 comes all the way down to 2002 in the CRB index, that basket of commodities, and from 2002 has taken off again. Yeah? Yeah. Right. Now, so we can presume this has got something to do with the dollar. So I dug into old US dollar, USDX charts. And it's hard to get the one that goes all the way back that is modern as well. But this gives us the idea that the dollar was right up at 120. Now, up is relative to where it had come from, but it was at 120 in 2002, and as we can see, the value of the dollar against baskets of other currencies, especially the euro, from 2002 to 2008 came down and down, and this more than definitely gives us why everything is becoming so more expensive. 2002 was the changeover year. Now, this one is the USDX, link number 4 is USDX, but more up to date. The last one ended with it down below 75, but the Great Recession panic brought safety trade back into the dollar and pushed it back from 75 through 78, where this chart starts, and up to 88 at the height of the crisis when everyone was panicking and came into the dollar, and then through 2010-11 it's come down to 74 again, but it didn't go down, and it's actually gone up slightly to 80, and this 80 number is the number that I'm saying is a kind of a limit that the Fed, Treasury, government will not want the dollar to go higher than that, because they'll be into all this export stuff that they want to do now, and it's exports which are taking priority. So it's at 80. I have no idea if they have any ideas for numbers. 80 might be the ceiling. I'm saying 82 would be an absolute ceiling, and they won't let it go above that. Right, I don't know if that's been helpful or confusing, but it shows us the factor of how a currency is perceived, because currencies are only perceived against other things. USDX is against other currencies, and the CRB index is a currency against a basket of commodities. Right, getting out of that and out of America and into the world, bottom 10 sovereign CDS ranked by spread end of March 2012. You can really say for this, these are the countries most likely to default according to CDS spreads. Cyprus, Portugal, Ukraine, Argentina, Venezuela, Ireland, Hungary, Egypt, Lebanon, and that's the important one at the bottom in number 10 is Spain. Spain has come in. Its February ranking was 16th, and it's come up the charts to number 10, and it's rising far too quickly for the nice sleep for the euro mandarins. Spain, it's very dangerous to have Spain in there. Right, on the euro sorting out things, this is quite interesting. It's not mind-blowingly interesting, but it's vaguely interesting. We've got the how much it costs to buy money, and that's what when you borrow money, money is a commodity. If you want it, say for a mortgage, you want to buy some money for a mortgage, you have to agree to an interest rate. The more the interest rate, the more price you're paying for your money. In Greece, at the top, we have in dark blue last year and in grey this year, and you can get a mortgage cheaper in Greece now. You can get a mortgage cheaper in Germany now, but whether you will be able to in 3 months or not, I wouldn't like to say, because Germany are starting to turn the screws on anything that might cause inflation. They're putting up bank this, that, the others, trying to manage tightening the money so it doesn't spurt out into Germany. Ireland, you can get a cheaper mortgage, and those are the three that are above the EU average. Now, this is vaguely interesting that down at the bottom, let's start with the positive ones. When you've got red, that means on the right, it means that mortgages are more expensive. They're more expensive this year in France. They're more expensive this year in Spain, more expensive in Portugal and Italy. Now, this is quite interesting. Again, for Spain, you're having a mortgage stroke housing crash and now mortgages are more expensive. And same, they're not having a housing crash in Italy, but the mortgages are more expensive in Italy and Spain, but not in Greece. It just shows that there are whole twisted things going on. But obviously mortgages being more expensive in Spain will not help their housing crash. Nothing in Spain that's happening will help their housing crash. They've kept it under the carpet because banks aren't accepting the losses, and they are recourse loans, so it's just not easy to hand your mortgage back in. People have just been waiting and trying to live through it. But Spain is really coming under a lot of pressure now, and it is via the mortgage market, via the banks, that the thing will explode. Have I got one more? Oh, I've got two more, I think. Okay, world oil. Iran has stopped now selling oil to Greece. Greece could only get oil from Iran, really, because Iran was desperate to sell, Greece was desperate to buy, but nobody else would take Greece's credit except Iran, and now not even Iran will give oil to Greece, so others will have to import it for them and sell it to Greece. Maybe the EU will have to sort that out for them. And finish with this, which is Modern Monetary Realism, a site that people should be following, because modern monetary realism is the new name for modern monetary theory. But this particular one, Money-like Instruments, Part 2, and Cardiff Garcia's Awesomeness. It's the Financial Times article that I spent nearly half an hour wobbling about. And this article is frighteningly like my half-hour video. It pulls out just about all the points that I pulled out, but there are more points in there, and you can, just by reading it, you can see that this fella, Michael Sankowski, knows what he's talking about, where I was struggling and waffling quite a lot. So if you were the slightest bit interested in what I was saying in that long, wankish video, go to this one and get a bit more clear, concise information from somebody who really knows what they're talking about. Woden's Day.